Hi, and welcome back. This is part 2 of 5 of Real Estate Market Reports. In this session, we're going to learn about the 3 different types of real estate markets and how much of an impact they're going to have on your discussions with real estate agents and home sellers on the benefits of home staging and the return on staging investment. Briefly, let's talk about the 3 different types of markets. The first one is a seller's market. A seller's market is one which there is less than 4 months supply of homes on the market. A normal market is one where you have 4 to 6 months supply of homes on the market, and a buyer's market is where there is more than 6 months supply of homes that are on the market. Let's go into each one of these in a little greater detail. In a seller's market, remember there's less than 4 months supply of homes on the market. In this type of market, sellers can typically hold firm on their asking price and not provide much in way of concessions to buyers. They often get multiple offers in short periods of time. Buyers are not in a position to negotiate much in their favor in this type of market. And a staged home will often sell for more money than other non-staged properties. In a normal market, there is an equal supply of homes that meets demands by buyers, meaning there's a 4 to 6 month supply of homes on the market. While sellers are not in a position to remain firm on their asking price, buyers are not much in a position to demand concessions or price negotiations. However, there is room for negotiations on both sides. In this type of market, a staged home will often sell both in less time and for more money than other non-staged properties on the market. In the buyer's market, there's just too many homes on the market. There's a 6 month supply of homes. Many homes will typically sit on the market for months with 1 or more price reductions. Oftentimes with little or no showings, many times with little or no offers, or perhaps 1 or more lowball offers. In this type of market, sellers are not in a position to negotiate much in their favor, whereas buyers can demand and expect sales concessions and price reductions. In this type of market, a staged home will often sell in much less time than other non-staged properties on the market. Now this chart shows you what you should be focusing on when you talk about the benefits of home staging and ROSI calculations to both real estate agents and home sellers when you're in one of these 3 different real estate markets. Well, this provides a wealth of information, so let's break it down in 3 parts. In the first part, we're going to talk about a seller's market. Seller's market, if you remember, there's not enough homes on the market. Typically, homes are selling in less than 60 days. Sometimes out as much as 90 to 120 days. In this type of market, you should focus more on how much more the sellers can receive or expect to receive on the sale of the home rather than how much less time the homes will sell. If homes are selling in 30 to 60 days, they're not going to be much interested in home staging because there's no benefit to them. When you're in a normal market, remember, you have a normal supply of homes on the market. Typically, homes will be on the market for 100 to 180 days. Here, you want to provide an equal emphasis on both how much more money they can get on the sale of the home, as well as how much time they will save when they're trying to get their home sold. Now, in a buyer's market, there are, remember, too many homes on the market. There's more than 180-day supply of homes. Here you want to focus more on how much less time a staged home can sell in this time of market rather than how much more money they can expect to receive. So let's take a look at this graph together again, and you again to see a little bit easier to digest. You're in the seller's market, normal market, and buyer's market. When you're in the seller's market, focus more on how much more they can expect to receive from the sale of the home. Whereas in a buyer's market, you want to focus more on how much less time a house will sell than other non-staged properties on the market. And then when you're in a normal market, place an equal benefit assessment on both a time savings and an increase in the sale price of the home.